The year is 2024, a year that many hoped would bring stability and growth, but instead, it has brought a sense of déjà vu, a haunting reminder of past economic crises. The world watches in disbelief as stock markets tumble, the red numbers flashing ominously on screens across the globe. From the bustling floors of the New York Stock Exchange to the high-tech trading rooms in Tokyo, the fear is palpable. Traders, who once exuded confidence, now wear expressions of deep concern. This is not just another market correction, it feels eerily familiar, like the prelude to something much bigger and more catastrophic. The tension in the air is thick, reminiscent of the days leading up to previous financial disasters. Echoes of 2008, even 1929, reverberate through the financial district. The chaos, the uncertainty, the fear, it all feels like a replay of history's darkest economic hours. Are we on the precipice of another global economic meltdown? The signs are all there, and the parallels to past crises are too striking to ignore. The signs are ominous, and history, as we know, has a nasty habit of repeating itself. The past downturns serve as grim reminders of what could lie ahead if we do not act swiftly and decisively. The markets are in turmoil, volatility is rampant, and the once predictable patterns have given way to chaos. Every tick of the stock market ticker feels like a countdown to disaster. Investors, once brimming with confidence, are now gripped by uncertainty. Their anxious faces tell the story of a world on edge, a world where financial stability is no longer a given. The bears are in control, and the bulls seem to be nowhere in sight. The symbols of market sentiment have shifted dramatically, reflecting the deep-seated fears of investors. From Wall Street to Dalal Street, the mood is one of apprehension. The global financial hubs are united in their anxiety, as the ripple effects of the market turmoil spread far and wide. The question on everyone's mind is simple yet terrifying. How bad will it get? Financial analysts on TV debate the potential outcomes, but no one seems to have a definitive answer. This is not a time for complacency. The empty office spaces and the constant checking of financial news on phones are stark reminders that we are in uncharted territory. This is a wake-up call. The alarm bells are ringing and people are gathering around their TVs, desperate for any piece of breaking news that might offer some clarity or hope. The global economy is teetering on the brink, and the worst may be yet to come. The indicators are flashing red, and the metaphorical edge of the cliff is closer than ever. We need to understand the forces at play, the factors driving this downturn, and what we can do to mitigate the damage. Economic analysts are working around the clock, dissecting charts and graphs, trying to make sense of the chaos. The stakes are high, and the time to act is now. Urgent meetings are being held in boardrooms across the world, and the metaphorical clock is ticking down. The decisions made in these moments will shape the future of the global economy. Across the Pacific, the Nikkei 225, Japan's benchmark stock index, has taken a nosedive. The worst sell-off since 1987 sent shockwaves through global markets, a stark reminder of the interconnectedness of the global economy. Japan, the world's third-largest economy, is a bellwether for global trade and finance. When Japan sneezes, the rest of the world catches a cold. Some analysts point to Japan's heavy reliance on exports, particularly to the United States. With fears of a U.S. recession growing, Japan's export-oriented economy is particularly vulnerable. Others cite Japan's own economic woes, including a mountain of government debt and sluggish growth. Whatever the reasons, the Nikkei's plunge is a canary in the coal mine. It serves as a warning sign, a harbinger of potential trouble brewing in the global economy. Ignore it at our peril. In the United States, the Federal Reserve's aggressive interest rate hikes have injected a potent dose of uncertainty into the markets. The Fed's efforts to combat inflation, while necessary, have come at a cost. Higher interest rates make it more expensive for businesses to borrow money, potentially slowing down economic growth. The stock market, a forward-looking beast, is already pricing in the possibility of a recession. As interest rates rise, investors are pulling money out of stocks and into safer assets like bonds. This flight to safety is putting downward pressure on stock prices. The Fed's predicament is a delicate balancing act. Raise rates too quickly and risk triggering a recession. Keep rates too low, and inflation continues to erode purchasing power. Finding the right balance is crucial, but the path forward is fraught with risk. Unemployment rises cracks in the facade. For months, the U.S. economy seemed to defy gravity. The stock market was soaring, businesses were expanding, and consumer confidence was at an all-time high. It felt as though nothing could go wrong. Despite rising inflation and interest rates, unemployment remained low. This was a puzzling phenomenon for many economists who expected that higher costs and borrowing rates would slow down hiring. However, recent data suggests that the cracks are beginning to show. The once robust facade of the economy is starting to reveal underlying weaknesses. The unemployment rate has ticked upward, a sign that the Fed's rate hikes may be starting to bite. This is a critical indicator because it reflects the health of the job market and, by extension, the overall economy. Jobless claims, a measure of layoffs, have also been creeping higher. This suggests that companies are beginning to feel the pressure and are cutting back on their workforce to manage costs. While these numbers are still relatively low, they suggest that the labor market may be cooling. A cooling labor market can lead to reduced consumer spending as people become more cautious with their money. This is concerning because a strong labor market has been one of the few bright spots in the U.S. economy. It has provided a buffer against other economic challenges, such as trade tensions and global uncertainties. If unemployment continues to rise, it could further dampen consumer spending, which accounts for roughly 70% of U.S. economic activity. Consumer spending is the lifeblood of the economy, driving growth and supporting businesses. A slowdown in consumer spending would be a significant blow to the economy and could tip the U.S. into a recession. This would have far-reaching consequences, affecting everything from small businesses to large corporations, and ultimately the livelihoods of millions of Americans. Policymakers and economists are closely monitoring these developments. They are debating the best course of action to prevent a full-blown economic downturn. Some argue for more aggressive monetary policies, while others believe in fiscal measures to stimulate growth. The decisions made in the coming months will be crucial. They will determine whether the U.S. can navigate through these cracks in the facade, or if the economy will face a more severe crisis. The stakes are high, and the world is watching. As we move forward, it is essential to stay informed and understand the implications of these economic indicators. The health of the job market, consumer spending, and overall economic stability are interconnected. Each plays a vital role in shaping the future of the U.S. economy. In conclusion, while the U.S. economy has shown remarkable resilience, the recent rise in unemployment is a warning sign. It reminds us that no economy is invincible and that vigilance and proactive measures are necessary to maintain stability and growth. The S rule, an ominous signal. Economists and market analysts rely on a variety of indicators to predict recessions. These indicators are crucial for making informed decisions about investments, policymaking, and understanding the overall economic health. They analyze a plethora of data points from employment rates to consumer spending, but one of the most telling signs comes from the bond market. One such indicator, the so-called S rule, has flashed red, raising concerns about the health of the U.S. economy. This signal is not just a minor blip. It has historically been a precursor to economic downturns. When the S rule activates, it sends ripples of anxiety through financial markets and boardrooms alike. The S rule focuses on the shape of the yield curve, which plots the interest rates of U.S. Treasury bonds against their maturity dates. The yield curve is a fundamental tool in finance, often used to gauge the market's expectations for future interest rates and economic activity. Typically, the yield curve slopes upward, meaning that long-term bonds have higher interest rates than short-term bonds. This upward slope indicates that investors expect the economy to grow in the future, and they demand higher returns for the increased risk of holding longer-term securities. This is because investors expect to be compensated for the greater risk of lending money for a longer period. The longer the duration, the more uncertainty there is about future economic conditions, inflation, and interest rates, which is why long-term bonds usually offer higher yields. However, when the yield curve inverts, meaning that short-term rates are higher than long-term rates, it is often seen as a sign that investors are pessimistic about the economy's future prospects. An inverted yield curve suggests that investors expect economic growth to slow down or even contract, leading to lower interest rates in the future. The S rule refers to the fact that an inverted yield curve often resembles the letter S. This visual cue is a stark reminder that the bond market is signaling trouble ahead. Historically, an inverted yield curve has been one of the most reliable predictors of recessions, often preceding economic downturns by several months to a couple of years. By examining historical data, analysts have found that every recession in the past 50 years was preceded by an inverted yield curve. This makes the S rule a critical tool for economists and investors alike. When the yield curve inverts, it doesn't just affect the bond market, it has far-reaching implications for stocks, real estate, and even consumer confidence. The recent inversion of the yield curve has reignited fears of an impending recession. News outlets and financial analysts are closely monitoring the situation, providing updates and insights to help the public understand the potential impact. The S rule serves as a warning, urging policymakers and investors to brace for possible economic turbulence. Policymakers may respond to the S rule by adjusting interest rates, implementing fiscal stimulus, or taking other measures to mitigate the potential downturn. Investors, on the other hand, might reallocate their portfolios, seeking safer assets to protect their investments. Understanding the S rule and its implications can help individuals and businesses make more informed decisions. Whether it's planning for retirement, managing a business, or simply staying informed about the economy, the S rule is a vital piece of the financial puzzle. In conclusion, the S rule is more than just a technical indicator. It's a powerful signal that can provide valuable insights into the future of the economy. By paying attention to the yield curve and understanding the significance of its shape, we can better prepare for what lies ahead.